Hey everyone, and welcome back to the Wealth of Good Life podcast. We're diving deep into a topic that's probably on a lot of your minds. Student loan refinancing, whether you're currently swimming in student loan debt or just want to be financially savvy. This deep dive is for you. We've been digging into all the latest research and expert opinions on refinancing, and honestly, we found some pretty eye-opening stuff, things that might just change how you view those loans. So get ready as we tackle some big questions like, could refinancing actually help you slash thousands of dollars off your interest? What is the truth behind all those crazy low interest rates that get advertised everywhere you look? And are there any hidden downsides to refinancing that no one's really talking about? Our goal today is to give you all the knowledge you need to make informed choices about your student loans. And joining me to break it all down is the amazing expert speaker. So let's jump right in. Can you start by just breaking down the basics of student loan refinancing? What does it actually mean?
Sure thing. It's basically like swapping out your old student loan for a brand new one, hopefully with better terms like a lower interest rate. Kind of like trading in an old gas guzzler for a fuel-efficient car.
Okay, yeah, that makes sense. But why would lenders be so eager to offer these lower rates? What's in it for them?
Well, it all boils down to competition. Lenders are constantly vying for your business, right? And offering tempting low rates is one way to stand out from the crowd.
So refinancing could actually be a total game changer for people trying to, save some serious money.
Absolutely. I've seen cases where people have saved, tens of thousands of dollars in interest just by refinancing. It can be a huge step toward achieving real financial freedom.
Wow, tens of thousands.
Yeah.
That's not chump change.
Yeah.
Okay, so besides saving money, are there any other perks to refinancing?
Yeah, definitely. Lower monthly payments are a big one. It gives you some much-needed breathing room in your budget. You can also simplify your life by consolidating multiple loans into a single one, and even release a cosigner if you meet certain requirements.
All right, that cosigner release can be huge. I know a lot of people who would love to give their cosigners a break. And speaking of making things easier, I know some lenders like Splash Financial specialize in helping married couples combine their loans. That's a big win for couples who are, tackling debt together. So all of this sounds pretty amazing so far, but I'm guessing there's some ground rules here. Who exactly qualifies for these refinancing deals?
You're right, it's not a free-for-all. Lenders have specific criteria they use to evaluate borrowers, and those can vary from lender to lender.
So can you break down what some of those criteria are? What are the key things lenders are looking for?
Well, one of the most important factors is your credit score. Lenders want to see a good to excellent score, typically 700 or above. It's basically an indicator of your financial responsibility. They also look at your income and your debt-to-income ratio, which basically measures how much of your income is already going towards debt payments.
Okay, hold on. Let's pause there for a sec. I think it's important to break that down for our listeners. So what exactly is debt to income ratio and what's considered manageable for refinancing?
Sure. Debt-to-income ratio, or DTI, is simply the percentage of your gross monthly income that's dedicated to debt payments. So let's say you earn $5,000 a month and you're paying $1,000 towards debts. That means your DTI is 20%. For refinancing, lenders usually look for a DTI below 43%, but this can definitely vary.
Got it. So it's not just about how much you earn, but also how much of that income is already tied up in other debts. Makes sense. Okay, so now let's talk about interest rates. One thing we see a lot when researching refinancing is this whole fixed versus variable rate thing.
Yeah, that's a big one.
Can you break down the difference between those two and maybe talk about which one might be a better fit for our listeners?
Of course. A fixed rate is kind of like a reliable anchor. It stays the same throughout the entire life of the loan, so your monthly payments are totally predictable. This can provide a lot of peace of mind, especially if you value stability and knowing exactly what to expect each month.
Okay, that makes sense. What about variable rates? What's the catch with those?
Variable rates are a bit more like, riding a wave. They go up and down with market conditions, so they might start lower than fixed rates, but there's always the risk that they could increase over time.
So it's kind of a gamble then. Variable rates offer potential savings, but also potential risk.
Exactly. The best choice really depends on your individual risk tolerance and your overall financial goals. If you value stability and predictability, fixed rates are usually the safer bet. But if you're okay with some risk and you're hoping to snag those lower initial payments, a variable rate might be worth considering.
Gotcha. Before we go any further, I want to remind everyone to visit wealthygoodlife.com. You'll find a ton of great resources there on managing your finances, everything from budgeting tips to investment strategies. We're here to support you on your journey to financial wellness. Okay, now something we kept seeing while researching refinancing was this distinction between federal and private loan refinancing.
Yeah, that's a really important distinction.
Can you explain the difference and why our listeners should care about this?
Absolutely. It boils down to this. When you refinance federal loans into private loans, you lose out on certain benefits, benefits that are only offered by the government.
Okay, let's pause there for a sec. What kind of benefits are we talking about?
We're talking about things like income-driven repayment plans, which adjust your monthly payments based on your income. This can be a lifesaver if you're facing financial hardship. And then there are loan forgiveness programs like public service loan forgiveness or teacher loan forgiveness. These programs can wipe out your debt entirely after you meet certain requirements.
Okay, so it's not just about the interest rate. These programs offer significant financial relief and even, complete debt elimination for those who qualify.
Precisely. And we can't forget about deferment and forbearance options. These allow you to temporarily pause payments if you lose your job or face unexpected challenges. And these options are generally more flexible and generous with federal loans compared to private loans.
So refinancing federal loans could mean losing access to a whole safety net of programs.
Yeah.
That's a serious thing to consider.
It is. And while refinancing private student loans doesn't carry that risk, it's still crucial to weigh your options carefully. Consider the loan terms, the fees, the flexibility, and the customer service of each lender before making a decision.
Right, it's all about making an informed choice that aligns with your specific situation. Okay, so we've covered the basics of refinancing, the potential benefits, and who qualifies. Now let's get into the nitty-gritty of comparing different refinancing options and finding the best fit for you. What are some practical tips for navigating this process?
Well, the most important thing is to shop around. Don't just settle for the first offer you get. Compare offers from multiple lenders because each lender will have their own set of terms and conditions. It's kind of like finding the perfect outfit, you know? You need to try on a few different options before you find the one that fits you best.
I love that analogy. And just like with clothes shopping, we don't want to get so distracted by a flashy deal that we overlook the important details. So what are some of the things borrowers should be paying close attention to when comparing these offers?
You're absolutely right. Don't just get fixated on the interest rate. You need to look beyond the surface. Think about the loan terms. How long is the repayment period? Is it 5 years, 10 years, or even longer? How will that affect your monthly payments and the total amount of interest you'll end up paying? And what about fees? Some lenders have origination fees, application fees, or even prepayment penalties. Make sure you factor all of those into your calculations.
So it's like reading the fine print on a contract. We got to make sure we understand all the terms and conditions before we sign anything.
Exactly. And beyond just the numbers, you should also consider the lender's reputation and their customer service. Look for lenders who are known for being responsive, transparent, and willing to work with borrowers. It can make a huge difference in your overall experience.
Totally agree. Speaking of finding the perfect lender, we came across a resource called Credible while doing our research.
Oh, yeah, Credible's great.
Can you tell us a bit more about them?
Sure. Credible is a fantastic platform that lets you compare pre-qualified rates from multiple lenders without affecting your credit score. Think of it like your own personal loan concierge. They do all the heavy lifting of gathering quotes so you can easily see what's out there and choose the best offer.
So they're like a matchmaking service for student loans.
Precisely. And they've helped borrowers refinance billions of dollars in student loans, so they clearly have a lot of experience and a proven track record.
That's impressive. If you're feeling overwhelmed by the thought of comparing all these different refinancing options, Credible is definitely a valuable tool. And for more tips on securing the best deal, be sure to head over to wealthygoodlife.com. We've got a treasure trove of information to help you navigate the sometimes confusing world of student loans. All right, let's dive a little deeper into this whole federal versus private loan refinancing thing. Can you walk us through the pros and cons of each, especially for those who are considering refinancing their federal loans?
Sure thing. Refinancing federal loans into private loans can have some advantages. Especially if you have good credit and a stable income, you might be able to snag a lower interest rate, which could lead to some significant savings over the life of your loan. And having a lower monthly payment can free up some space in your budget, which is always a plus.
Okay, so those are some pretty compelling reasons to consider refinancing federal loans. But what about the potential downsides? What are we giving up?
The biggest thing to remember is that federal loans come with certain protections and programs that private loans simply don't offer. By refinancing federal loans into private ones, you're essentially forfeiting access to these valuable benefits.
Right, okay. Let's remind our listeners about some of those key differences. What are some of the specific things you lose when you refinance federal loans into private ones?
Well, one of the biggest losses is access to income-driven repayment plans. These plans are designed to make your monthly payments more manageable by basing them on your income. They can be a real lifeline for borrowers who are facing financial hardship.
Okay, so how exactly do these income-driven repayment plans work?
There are actually a few different plans available, like Pay Repay, IBR, and ICR. Each one has slightly different eligibility requirements and calculation methods, but they all basically aim to keep your monthly payments affordable by capping them at a certain percentage of your income. And after a set number of years of on-time payments, typically 20 or 25 depending on the plan, any remaining balance on your loan is forgiven.
Wow, that's huge. So for those who, might be dealing with income fluctuations or who work in lower paying fields, these income-driven repayment plans can be a total game changer. And that forgiveness aspect is a massive benefit too.
Absolutely. These plans can be especially valuable for people who are pursuing careers in public service, where salaries might be lower, but the impact is significant. For them, the Public Service Loan Forgiveness Program, or PSLF, can be a lifesaver.
Right. PSLF offers complete loan forgiveness after 120 qualifying payments, as long as you're working full-time for a qualifying government or nonprofit organization.
Exactly. And there's also teacher loan forgiveness, which provides similar benefits for educators who dedicate their careers to serving students in low-income schools.
It's like a reward for dedicating your career to serving others. You get the satisfaction of making a difference and the financial relief of loan forgiveness.
I like to think of it that way.
So essentially, refinancing federal loans could mean saying goodbye to some really vital safety nets.
That's right. It's a trade-off, lower interest rates and monthly payments in exchange for potentially losing valuable federal benefits and protections.
It's a big decision.
It is. And while refinancing private student loans doesn't come with the same risk of losing those federal benefits, it's still really important to think things through carefully. Consider the loan terms, the fees, the flexibility, the customer service of each lender, and really think about your long-term goals before making a decision.
So it's about finding the right balance between financial savings and financial security. It's a decision that requires you to really understand your own needs and priorities.
I couldn't agree more.
Oh.
Welcome back to our deep dive into student loan refinancing. All right, so let's pick up where we left off and dig into some more of the, ins and outs of this whole refinancing thing.
Yeah, there's definitely a lot more to unpack here. And we want to make sure our listeners have all the info they need to make, smart choices about their loans. One thing that really stood out to me while we were researching was how much refinancing rates have fluctuated in recent years. For example, back on November 13, 2023, the average interest rate for a 10-year fixed-rate loan was 7.75% for borrowers with good credit. But 5-year variable rate loans were averaging 6.32%.
Yeah, that's a pretty big difference. And it just goes to show how important it is to, shop around and really compare offers from different lenders. It's not just about finding the lowest rate, it's about understanding all the different factors that influence those rates and then choosing the option that best aligns with your individual situation.
Right. So besides, checking our credit score, what else can borrowers do to make sure they're getting the most favorable rates possible?
Well, it's a combination of things. Your credit score is definitely a major factor. The higher your score, the better your chances of qualifying for those lower rates. But lenders also look at things like your income, your debt to income ratio, and even your education level and field of study. And don't forget about the loan terms. Choosing a shorter repayment period, like 5 years instead of 10 years, might mean higher monthly payments, but you'll typically end up paying less interest overall.
So it's all about finding that sweet spot, a balance between a monthly payment you can actually manage and minimizing the total interest you pay over the life of the loan.
Exactly. And that's where working with a knowledgeable financial advisor can be really helpful. They can analyze your financial situation, weigh the pros and cons of different loan terms, and guide you towards the best decision for your unique goals.
Right, having that expert guidance can make a huge difference.
Yeah.
Okay, so we've talked about general factors that affect rates, but what about lender preferences? While researching, we noticed that some lenders seem to cater to specific types of borrowers.
Oh, yeah, definitely.
For example, First Republic Bank, they seem to focus on borrowers with, excellent credit and larger loan amounts.
Yeah. They're known for offering some of the lowest rates on the market, but they also have stricter eligibility criteria.
Can you talk a bit more about First Republic's approach and, what makes them unique?
Sure. So one thing that sets First Republic apart is that they require borrowers to have a checking account with them. And you also have to live in an area where they have a branch.
Oh, wow. So it's kind of like an exclusive club for student loan refinancing.
You could say that. This strategy allows them to manage risk more effectively. They're basically ensuring that they're working with borrowers who have a proven track record of financial stability.
Interesting. So it seems like First Republic could be a fantastic option for borrowers with stellar credit who are looking to refinance a significant amount of debt. But for those who don't meet their specific criteria or who prefer a lender with more flexibility, there are definitely other great choices out there.
Lovely.
Speaking of flexible lenders, we were really impressed by Common Bond's commitment to, supporting borrowers through those like unexpected twists and turns that life throws at us.
Yeah, they're great.
They offer up to 24 months of forbearance, which could be a total lifesaver for those facing financial hardship.
It's true. Common Bond really understands that life doesn't always go according to plan, and they're willing to work with borrowers who might need a temporary break from payments. They also have cosigner release options, which is a big plus for those who want to remove a cosigner from their loan after establishing a solid payment history.
Right. It's like they're saying, hey, we get it. Life happens.
Yeah,
And that kind of understanding and support can be so valuable when you're dealing with, the stress of student loan debt.
for sure.
Okay, so let's shift gears a bit and talk about the application process itself.
Mm-hmm.
What are some tips for making this whole experience, as smooth and stress-free as possible?
The number one tip I always give people is to be prepared. Gather all of your important documents before you even start filling out any applications.
Like what kind of documents?
Things like your loan statements, proof of income, your social security number, basically anything the lender might ask for. Having everything organized and ready to go will save you so much time and hassle down the road.
Right, it's like packing for a trip. You don't want to be scrambling for your passport at the last minute.
Exactly. And just like with travel, it's always a good idea to do your research and compare your options. Remember those online pre-qualification tools we talked about earlier? Those are a fantastic way to get a sense of what rates and terms you might qualify for without impacting your credit score.
Right, it's like a test drive before you commit.
Exactly.
Okay, so once you've done your research and narrowed down your choices, what's the next step?
Take your time and carefully review each lender's terms and conditions. Pay close attention to things like the interest rates, the repayment terms, any fees, and especially any prepayment penalties. Don't be afraid to ask questions if anything is unclear. Remember, this is a big financial decision, so you want to feel confident and comfortable with every single detail.
It's like signing a contract. You want to make sure you understand all the fine print.
Absolutely. And once you've found a lender that you feel good about, complete the application thoroughly and accurately. Double-check everything before you submit it to avoid any unnecessary delays.
Attention to detail is key.
It is.
Okay, now let's talk about a group of borrowers who often face unique challenges when it comes to refinancing international students.
Yeah, it can be a bit trickier for them.
What are some of the specific hurdles international students might encounter, and what advice do you have for them?
So one of the biggest challenges for international students is that many lenders require a U.S. citizen or permanent resident to qualify for refinancing. They often have stricter eligibility criteria.
Oh, wow. So it can feel like a dead end for them.
Well, it doesn't have to be.
Are there any lenders who specialize in working with international borrowers?
Absolutely. Lenders like Prodigy Finance and Empower Financing are specifically designed to meet the needs of international students. They understand the unique circumstances these borrowers face, and they're willing to consider factors beyond just traditional credit scores. Things like academic performance, future earning potential, and the overall economic strength of the borrower's home country.
That's really great to hear. So it's not a hopeless situation.
Not at all.
Any other advice for international students who are considering refinancing?
The key is to do your research and find a lender who truly understands your specific needs. Don't be afraid to reach out to multiple lenders and ask about their eligibility criteria for international borrowers. You might be surprised at the options that are available to you.
So persistence and research are key.
Definitely.
Okay, let's move on to another group of borrowers who often have questions about refinancing parents who took out parent PLUS loans to help their kids pay for college.
Yeah, those loans can be tough.
What are some key considerations for parents who are thinking about refinancing these parent PLUS loans?
So parent PLS loans are a unique type of federal loan that typically have higher interest rates than most other federal loan options. And they're often taken out by parents who might have limited credit history, which can make qualifying for refinancing a bit challenging, especially if their credit scores aren't great.
So it's kind of a double whammy,
It can be.
high interest rates, and maybe not the best credit worthiness.
Right.
That's a recipe for financial stress.
It can be, but there are definitely strategies parents can use to improve their chances of getting approved for refinancing. One option is to add a cosigner with good credit to the loan application. This can really strengthen the application and potentially lead to a lower interest rate.
So it's like having a financial wingman.
Exactly. Someone who can vouch for you and give lenders more confidence in your ability to repay the loan. Another option is to focus on improving the parent's credit score before applying for refinancing. This might involve paying down existing debts, making all payments on time, and disputing any errors that might be on their credit report. Taking these steps shows lenders that you're serious about managing your finances responsibly, and it increases your likelihood of getting approved.
So it's all about taking control of your financial health
Hmm.
and, presenting yourself in the best possible light to lenders.
Exactly.
Any other advice for parents who are considering refinancing parent POUS loans?
Well, just like with any other type of federal loan, it's essential to remember that refinancing means giving up access to certain federal programs.
Hmm.
Things like income-driven repayment plans and loan forgiveness options.
Right. That's a crucial point.
It is.
So again, it comes down to carefully weighing those trade-offs before making a decision.
Exactly.
There's no one-size-fits-all answer when it comes to refinancing.
It's all about finding the solution that aligns with your individual circumstances and your long-term goals.
I agree. And for those who are feeling overwhelmed or unsure about whether refinancing is the right move for them, there are definitely resources available to help you navigate this whole process.
For sure.
Organizations like the National Foundation for Credit Counseling offer free or low-cost counseling services. They can help you develop a personalized debt management plan.
That's a great resource. Having access to that kind of expert guidance and support can make a huge difference.
Right. And of course, knowledge is power. The more you understand about student loans and all of your different options, the better equipped you'll be to make choices that benefit you in the long run.
Absolutely.
We always encourage our listeners to visit wealthygoodlife.com. We've got tons of information there on managing your money, from budgeting tips to investment strategies.
It's a great resource.
We're here to empower you to make smart choices and achieve financial freedom.
That's what it's all about.
Okay, so let's shift our focus to another important aspect of student loan refinancing: choosing the right lender. With so many options out there, it can be totally overwhelming to know where to start.
Yeah, it can be a bit of a jungle out there.
So beyond just interest rates and loan terms, what are some other key factors borrowers should consider when making this decision?
You're right, it's about more than just the numbers. You want to find a lender who understands your needs and is committed to supporting you throughout your entire repayment journey. Think about things like customer service transparency and the lender's overall reputation.
Right.
Look for lenders who are responsive to your inquiries, provide clear and concise information, and have a track record of treating borrowers fairly.
It's kind of like choosing a doctor. You want someone who's not just skilled, but also someone you feel comfortable with and can trust.
Exactly. And don't underestimate the importance of technology. Look for lenders who offer a seamless online experience with easy-to-use applications, clear communication channels, and convenient ways to manage your loan payment.
Right. It's 2025. We expect our financial interactions to be as smooth and intuitive as, our online shopping experiences.
Absolutely. A lender who invests in technology is a lender who's invested in making your life easier.
Okay, so we've talked about choosing the right lender, but let's zoom out a bit and talk about a broader trend we're seeing in the student loan refinancing space: the increasing role of technology.
Yeah, technology is transforming everything these days.
It is. How is technology changing the game when it comes to student loan refinancing?
Well, we're seeing lenders leverage technology in all sorts of innovative ways, from personalized recommendations to automated repayment options. They're using technology to create a more streamlined and user-friendly experience for borrowers.
That's exciting. It sounds like the future of student loan refinancing is pretty bright.
I think so. And as more individuals take control of their student loan debt and explore options like refinancing, we'll likely see a positive ripple effect on the economy as a whole.
How so?
Well, when people feel financially secure, they're more likely to invest in their future, contribute to their communities, and fuel economic growth.
That's a great point. It highlights the importance of financial literacy and the positive impact it can have, not just on individuals, but on society as a whole. Okay, now let's address a question that often comes up when we talk about refinancing. What about those who are still in school or just starting their careers? Is refinancing even a possibility for them?
It depends. Refinancing typically requires a solid credit history and a stable income, which can be a challenge for those who are still building their financial foundation.
Right.
But there are some lenders out there who are more open to working with younger borrowers or those who are still in school.
Oh, that's good to hear. What are some of the lenders that cater to this segment of borrowers?
Lenders like College Ave and Ascent are known for their willingness to work with students and recent graduates. They understand that younger borrowers might not have a long credit history, and they're more likely to consider factors like academic performance and future earning potential when evaluating applications.
So it's like they're talent scouts for student loan refinancing.
I like that analogy.
They're looking for potential, not just past performance.
Exactly.
Any other advice for students or recent grads who are considering refinancing?
I would say shop around and compare offers from multiple lenders. Some lenders even offer options to start making small interest-only payments while you're still in school, which can help you save money in the long run by reducing the total amount of interest you accrue.
That's a smart strategy.
It is.
Okay, let's move on to a topic that's often shrouded in mystery and confusion, student loan forgiveness. Can you shed some light on how refinancing affects eligibility for various forgiveness programs?
Sure, this is a really important point that a lot of people miss. When you refinance federal loans into private loans, you essentially forfeit any potential eligibility for federal loan forgiveness programs, like public service loan forgiveness or teacher loan forgiveness.
That's huge. Those programs can be life-changing for so many borrowers. Can you remind our listeners about the basic requirements for these programs?
Of course. So, Public Service Loan Forgiveness, or PSLF, is a program designed for those who work in government or nonprofit organizations. To qualify, you need to make 120 qualifying monthly payments under an eligible repayment plan while working full-time for a qualifying employer. After you meet those requirements, the remaining balance of your loan is forgiven tax-free.
It's like a reward for dedicating your career to public service.
It is.
Okay, what about teacher loan forgiveness? How does that program work?
Teacher loan forgiveness offers up to $17,500 in forgiveness for teachers who work in low-income schools for 5 consecutive years. It's designed to encourage talented individuals to pursue careers in education, especially in areas where there's a shortage of qualified teachers.
So the takeaway here is that if you're working towards loan forgiveness through one of these programs, refinancing federal loans is definitely not a good idea.
You got it. However, if you're refinancing private loans, there's no impact on your eligibility for federal loan forgiveness. Since private loans aren't eligible for those programs anyway, refinancing them doesn't change anything in terms of federal forgiveness.
Got it. So it all boils down to knowing what types of loans you have and what forgiveness programs you might be eligible for before you even think about refinancing.
Exactly.
It's all about making informed decisions that align with your long-term financial goals.
I couldn't agree more.
And if you're unsure about your eligibility for forgiveness or have any questions about how refinancing might affect your specific situation, it's always a good idea to talk to a qualified financial advisor.
Definitely. They can help you weigh the pros and cons and make the best decision for your unique circumstances.
It's like having a financial coach in your corner.
Exactly.
All right, so we've talked a lot about, the nuts and bolts of refinancing, like interest rates and loan terms. But what about those less obvious factors, those things that can really make or break your experience?
Oh, yeah. Those are super important.
We're talking about things like customer service and the overall borrower experience.
Exactly. A great interest rate doesn't mean much if you're dealing with terrible customer service or a clunky online platform.
Right. It can turn the whole refinancing process into a total nightmare.
It can.
It's like going to a fancy restaurant with awful service.
Yeah.
The food might be amazing, but the whole experience is ruined by inattentive waitstaff.
Exactly.
So how can borrowers find a lender who not only offers a good deal, but also, provides a positive experience?
Well, research is key. Read online reviews, talk to friends and family who have refinanced their loans, look for lenders who have a reputation for being responsive, transparent, and helpful.
Right. It's like choosing a doctor.
Yeah.
You want someone who's not only skilled, but also someone you feel comfortable with and can trust.
Exactly.
And what about technology?
Oh, technology is huge these days.
It is.
You want to look for lenders who offer a seamless online experience,
Yeah.
easy-to-use applications, clear communication, and convenient ways to manage your loan payments.
Right. It's 2025.
Ah,
Our financial interactions should be as smooth and intuitive as, our online shopping experiences.
absolutely. A lender who's invested in technology is a lender who's invested in making your life easier.
Agreed. Okay, now let's circle back to a question that we touched on earlier. What about those who are still in school or just starting out in their careers? Is refinancing even an option for them?
It really depends. Most lenders want to see a solid credit history and a stable income,
Right.
which can be tricky for those who are still early in their financial journeys. But the good news is that there are some lenders out there who are more willing to work with younger borrowers or those who are still in school.
Oh, that's good to hear. So it's not a total no-go.
No, not at all.
What are some of the lenders who cater to this segment of borrowers?
Well, lenders like College Ave and Ascent are known for being pretty open to working with students and recent graduates. They understand that younger borrowers might not have a long credit history, and they're more likely to consider factors like academic performance and future earning potential.
Right, so it's like they're talent scouts for student loan refinancing.
I like that.
They're looking for potential, not just past performance.
Mm.
All right, let's talk about a topic that I think causes a lot of confusion: student loan forgiveness. Can you break down how refinancing affects eligibility for these various forgiveness programs?
Okay, so this is a really important point. When you refinance federal loans into private loans, you're basically saying goodbye to any chance of getting forgiveness through federal programs, like public service loan forgiveness or teacher loan forgiveness.
Wow, so that's a pretty big deal.
It
Those
is.
programs can be life-changing for borrowers.
They can.
Can you remind our listeners about how these programs work and who qualifies?
Sure. Public Service Loan Forgiveness, or PSLF, is for people who work in government or nonprofit organizations. To qualify, you need to make 120 qualifying monthly payments under an eligible repayment plan while working full-time for a qualifying employer. After you hit that 120 payment mark, any remaining balance on your loan is forgiven tax-free.
That's amazing. What about teacher loan forgiveness?
Teacher loan forgiveness is for well teachers. It offers up to $17,500 in forgiveness for teachers who work in low-income schools for 5 consecutive years.
So if you're working towards loan forgiveness through one of these programs, refinancing federal loans is definitely off the table.
Definitely. You'd be kissing those benefits goodbye.
Okay, but what about refinancing private loans?
Refinancing private loans doesn't affect your eligibility for federal loan forgiveness at all, because private loans aren't eligible for those programs to begin with.
Got it. So again, it all comes down to knowing what types of loans you have and what forgiveness programs you might be eligible for.
Exactly.
Do your research and make sure refinancing aligns with your long-term goals.
That's the best advice I can give.
And if you're still feeling unsure or confused about anything, talk to a qualified financial advisor.
Absolutely. They can help you figure out the best path for your unique situation.
All right, folks, that wraps up our deep dive into student loan refinancing. We covered a lot of ground today, from the basics to some more advanced strategies. We hope you feel empowered to make smart choices about your student loans and take control of your financial future. Refinancing can be a really powerful tool, but it's not the right choice for everyone. So do your research, weigh your options, and make the decision that's best for you. And don't forget to check out wealthygoodlife.com. We've got tons of resources there on managing your money, from budgeting tips to investment strategies. We're here to support you on your journey to financial well-being. Thanks for joining us on this deep dive. And remember, the path to financial success is a journey, not a destination. Keep learning, keep exploring, and keep striving for your financial goals. Thank you for listening to the Wealthy Good Life podcast.